give a sense of what we're here for. Let's see if I can shrink that. And what our mission is to provide the best education available with options to help people stay out of trouble. And this is what I wish I had when I first got started trading options, Mike. You had a real good mentor that was looking over your shoulder and helping you. I went to one of these seminars, one of these weekend seminars, and learned how to trade covered calls. And, the covered call trading guru told me that, geez, to really increase your returns, Kurt, you ought to trade on margin. I said, yeah, I'll do that. And so that kind of got me into trouble. Okay, so I'm trying to teach folks how to stay out of trouble in the first place. Okay, and raise awareness about the married put strategy. It's interesting because when I was investing in just mutual funds, Mike, I would look at the prospectus, and it would say that the fund manager from time to time would engage in married puts and collars.
Yes.
To protect the assets of the fund. And I remember thinking to myself, well, what's a married put? What's a collar? And I didn't know. And a lot of investors don't know, and many investors that do know what a married put is have a misconception about how it could be used. They don't realize how powerful of a tool it can be. And
they use it the wrong way.
Exactly. A lot of folks use it the wrong way, or use it as just a temporary measure instead of something to make them long-term bulletproof, I like to call it. Bulletproof is a situation, we'll show this situation a little bit later on, where you get to a place where your married put can no longer lose any capital. It doesn't start that way. It starts out underwater,
Well, technically, every option trade does so.
Well, every trade, any trade, doesn't matter what you are trading. The bid-ask spread ensures that you're going to start out a little bit underwater, right?
That's right.
You can buy a stock, for example, for 50, but you could only sell it for 49.90, right? Because of that bid-ask spread. Well, here's what I'm here to tell you: that it's possible to use the married put strategy to make an absolute stop, something that can't be violated by an overnight gap or anything, but can still allow you to take out income the way that those covered call trading gurus had promised us, being able to take income out of a play, but not necessarily limited its upside. So here's how to get the most out of today, folks. I'm going to ask you to participate, and since we've got a smaller number, usually right after the year-end promotion, everybody that's just recently come into our sphere of influence, everybody has either bought our products or they've decided not to, right? And so after our big year-end promotion, usually we have a smaller audience. Today we've got only 22 people on the line, and that's actually good. It's cozy, and we're going to be able to handle more questions. Okay. So usually I say, hey guys, hold your questions to the end. But you know what? If you want to just pop in there with a question now and again, we may answer it right at that time, or we may want you to be a little bit patient because perhaps the presentation itself is going to answer it. Okay, the lesson itself is going to answer it. So I'm going to ask you to participate in the polls and the prompts, and with that, I'm going to bring out the first prompt. I'm going to ask you to introduce yourself. Okay, so let's see here. What options trading methods are you currently doing? Okay, and it's possible that some of you are not trading options at all. In fact, recently we've had a larger than normal number of people saying, hey, I'm not using options.
Right.
Okay, and feel free to plug in more than one of these, okay? If you do cover calls and you also do long calls and puts, or if you do long calls and you also do spread trades, let us know. Wow, look how many folks are doing cover calls, Mike. Oh my gosh. That was up in the 80s there for a moment. Now it's down to 73 as more people are coming in and voting. All right. I'll leave that poll up there for just a few moments. We do have close to 20% that aren't trading options at all. And folks that aren't trading options, listen, we're going to show some things here today that are going to be really exciting even to experienced options traders. Okay, but we're not going to talk over your head. We're not going to get into a bunch of crazy jargon. But we are going to show some principles that many options players have not thought of, and I think it's going to be really exciting. Okay, let me go ahead and close that mic and share the results. The lion's share of, oh, look at that. It became a tie at the end.
Mm-hmm.
Wow, okay, we had, at one point it was 88% that were doing covered calls, but then more people came in and cast their vote, and so it's down to 69%. But look at that, another 69% are doing spread trades. So there has to be some overlap there. Some folks are doing, both. Pretty cool. 15% not trading options at all, 38% long calls and puts. Okay, cool. Now I got just a real simple question. Real simple question. How happy are you with it? How happy are you with your trading so far? That's the second question. Would you say that you're happy with the results? And rather than a straight up yes or no, I've got a spectrum of answers there, either very, very yes, or at the other end, very, very no. And in between, just varying shades of, I'm happy, but I could be happier, or, geez, I'm really not happy, but I'm not ready to quit either. So, okay. So far, nobody has said that they're ready to quit, and so that's good. If you were ready to quit, I'd want for you to tell me. Maybe after today you won't be. Okay, Mike, I'm going to leave this up for a shorter period of time than the other one because we're getting really good participation, and I don't think we need to hold out for the last 2 or 3 that can't get to their computer screen. I know some folks are calling in. Okay, so okay, so let me share that. What is the biggest results here?
Excuse me, Kurt. I'm sorry. We're making money, but not enough. Some people are having successes, but maybe they're giving a little bit back due to the strategy that they're applying. Maybe we'll talk about that in just a moment as well. But we're making money, but not enough, and that's good, but we want to see better. There is 8% that say that they're doing extraordinarily well. That's fantastic. And then the rest of our audience is sort of in the mixed emotions and lost money last year.
Yeah. I'm going to say that I'm really pleased by the fact that the top 2 are 75% of the audience. 75% of the audience are saying, well, I'm not losing money. And so that's good. But today, we're going to address, first of all, how to stop losing money, okay? But secondly, how to lock in gains that you already have. And so I'm glad that I chose today's particular lesson. We've got a bundle of different lessons that we rotate through. And today's particular lesson is going to be really good for the folks that are online. So that's a happy thing. Well, cool. Okay, guys. Well, let's jump into this. Now, everybody's heard this little chestnut of cut your losers short and let your winners do what?
We want to let our winners run. We want to leave our upside open and manage our losses.
Right. And the problem with that, though, is that it sounds like another piece of advice. Buy low, sell high. Sure, you've heard that one before, right? Buy low, sell high. Well, what is low? What is high? And how do I know when I've gotten to high?
And if it was that easy, everyone would do it and be successful.
Exactly. So if you give the practical instruction of how to accomplish this, cut your losers short and let your winners run. But in order to figure out what is the structure that's going to allow for or even force you into a place where you cut your losers short and let your winners run, let's look at the opposite of that. The opposite of cut your losers short and let your winners run is this. And Mike, we've got a lot of folks on the line that are doing it. We have about 7 out of 10. We had 69% of the audience that they got their votes in anyway. 69% doing covered calls. Well, I've got a saying for you. Okay, it goes like this: everyone's a genius in a bull market.
Of course.
Okay? So as prices are rising and we're getting into stocks and we're getting called out, okay, we are making money, okay? We're probably missing the big upside, just like, oh gosh, the fellow that traded DDD. What was his first name? Guy on here last week?
Was it Joe?
I wanted to say David.
Okay, might be David.
Well, anyway, could be Joe. You know what? I think you're right. I think it was Joe. Joe invested in DDD, and he very wisely didn't sell a covered call. If he had sold a covered call, he would have cut his winner short. He would have gotten called out. When DDD made an over 20% move, Mike, is he going to make over 20%?
Well, not with a covered calls trade. No, if he sold it as a covered call, he would have capped his gain and would have had to put more money into the position to realize any further gain than the 2.5%, 3% he agreed upon when he sold that call.
And by putting money back in, some folks aren't options traders today, so by putting money back in, what that means is buying back the covered call or closing out the obligation. He'd have to actually pay more than he took in on his covered call play to stay in the stock, right? And that's not what we came here to do. We didn't come here to pay more to stay in a stock. We want to be able to take advantage of the upside. Well, Mike, when you do a covered call, you certainly do limit your upside potential, but do you protect your downside?
Well, no. I mean, we can say, oh, well, we can cover our covered call cheaply by just using a stop order, which doesn't cost anything. But in any black swan event, unexpected event, a gap down of 15, 20, 25, or 30% of the stock itself, we're on the hook and going to get filled at that 30, 25, 20% loss. We're not going to get filled at our 6 or 7% loss where it's in our stop order because it's going to get violated and we're going to get filled at the worst price. So we're still taking on, let's assume we generated 3% premium, 3% of time value by selling the call. We're still technically risking 97% of what we invested in the stock position.
Right. If Joe's stock can gap up by 26%, it can also gap down by 26%. Right? And a stop order isn't going to help you there. It's going to get you hurt. So a covered call play isn't really the best because it cuts your winners short and lets your losers run. But what about spread trades? Okay. Now again, without trying to talk over the heads of folks that aren't doing options, we do have 7 out of 10 of folks in the room doing spread trades. And we know that when you do a spread trade, you're very often you take a credit on the front end, like with this bear call spread here. We're taking a credit on the front end, but there's a dark side to it, isn't there?
Well, yes. Now, there's 2 dark sides to it. Technically, if you send up a bear call spread, Kurt, let's say you and I are looking at a stock trading at maybe $48 per share, and we think that stock's going to stay at $48 or move down in price. We may sell the out-of-the-money 50 call and buy the 55. And we might generate 50 cents of net credit we're using a leverage trade, of course, so we don't have to put up the full money to get into this position. We only have to cover that $5 difference in the strike prices. So technically our maximum risk, if the stock went above $55 per share over on the right here, in the worst case scenario, the maximum risk would be the $5 strike difference minus our 50-cent net credit. So we're looking to make 50 cents but risking 450. So that's a 9-to-1 risk-reward ratio. So if I entered 10 trades, Kurt, and I was right on 9 of them and wrong on 1, I've essentially come out of the month at break even. I was right 90% of the time, but I came out of the month at break even. Now, what is the other problem we have with these spreads, Kurt?
Well, the other problem is if we were right, let's say we were right about our expectation, and the stock's at $48 and we think it's going to go down. So we sell our 50 by 55 spread and we take a credit. And we were really, really right. The stock went down to $2 a share.
Right.
Well, we don't get to make any more money. I mean, the measly 50 cents that we settled on in the first place is the most that we can possibly make. So again, this does cut our losers short in the sense that, well, if we are going to start to lose, we don't lose too much. It's not like an infinite risk, like selling a naked call or selling a stock short. It's not infinite risk, but it's not infinite gain either. It cuts your winners. Does not allow your winners to run. Okay, so I got this crazy idea, Mike, and this was over 10 years ago. I had been hurt. In fact, I got hurt so badly it cleaned me completely out of my account. My broker had called me. I was using a full-service broker then, back in the late 90s. I was using a full-service broker, and he called me and he said, hey, your stock opened at a little bit less than half where you bought in, and you're margined. So they want me to make a margin call. What do you want to do? And I was devastated. I was like, oh my God, you know, in the first 15 minutes of the market open, broker gives me a call and says, you have nothing.
Mm-hmm.
In fact, we need you to probably pay us some more. And that was crazy. But I got the idea that, geez, you know, why don't I just reverse my behavior? If I'm going to hedge my stock, if I'm going to hedge my stock, instead of shorting a call, why don't I just buy a put option? In fact, if that is what I had done in the case of the stock that I got into, I'd actually be ahead of where I started because of the income that I had taken in. And anyway, what I decided to do, Mike, was to start to cut my losers short and let my winners run. You know,
Mm-hmm.
this is a structure that actually does that. If you'll notice, this isn't my propaganda, by the way. This is off of a free education site. But let's go back 2 slides, okay? We've capped our upside with our bullish expectation, right? So our reward is limited.
True.
They say that it's safer. I don't necessarily agree because I just described to you how I went broke, right?
Well, it's safer than owning stock outright, but it's not really safer than you can really use options for. It's not, you know, the safest thing that you can do with options.
Right, yeah, a safer thing. You know, see, this is properly over to the far left. You know, it is definitely safer to do a protected put option, but the upside is unlimited. And I thought to myself, well, why wouldn't anybody want to do that? And then, you know, Mike, on Wikipedia, there was no entry for married put until I wrote it. I was the guy that put that up there in the first place. Most people just don't know about this, and if they do know about it, they don't know how to use it correctly. Okay, so I'm going to make 3 bold promises about using the married put and using it properly. First of all, I'm going to show you the solution to a big problem facing buy and holders today. Okay, it's going to make a lot of sense, and folks that were headed into this fiscal cliff, you know, with uncertainty. I think we still have some uncertainty, but you don't have to have uncertainty, okay? In fact, I'm willing to bet that you'll take a look back at your account and say, you know what? I would have stayed in those winning positions longer if I'd have done this, and I would have gotten out of that losing position with a much lower hit if I'd have done this. I'm going to bet that more people are going to be happy with their trading than said that they were happy today, okay? Number 2, I'm going to show a riskless spread trade. And Mike, we talked about spread trades having leveraged risk. Well, guess what? If you do it in the right context, if you do it in a certain way, you don't have to have risk at all. This is the riskless spread trade I'm going to show that's done at a credit. And normally, a credit spread involves risk, okay? But this riskless spread trade can pay you twice.
Mm-hmm.
I'm going to show 1 of 5 ways that it can pay you twice. Okay, that's kind of a neat deal. Okay, and then finally we're going to show how it's possible to bulletproof your stock so that you can't lose but you can win. Okay, so this is the deal. Bulletproofing is real. We've been doing it for years. We've been showing real money examples. And last week when I showed this very lesson, we were doing this lesson. Last week we had someone write in and say, hey, I'm bulletproof. That was Joe with his triple D position.
Mm-hmm.
Okay, is Joe on the line?
I don't think so, Kurt.
Oh, darn. Okay, I was hoping that maybe he had popped in. Okay, so again, we're going to solve a big problem once and for all. We're going to show a riskless spread trade that catches premium twice, and we also are going to show how to bulletproof a stock without limiting its upside potential. Okay, and so that's the deal. Now, just before we go on, all right, we're going to do an integrity quotient test. Okay, IQ test, and the IQ test goes like this. If what I showed makes a difference, okay, if it makes a difference to you, would you want to hear about an offer for a program that will give you more of the same? Would you like to hear about it? So far nobody said, no, I don't even want to hear the offer. Okay, so here's the deal. I'm just going to ask you to stick around for about 5 minutes at the end of today's lesson for the for the sales pitch. Okay, I'm just being blunt. I'm being honest. Okay, I'm going to make a sales pitch at the very end. All right, so it looks like we've got 100%. Not everybody voted, but I know that some of you can't get to your keyboards right now. You're calling in or whatever. Okay, but everybody that participated did say, yeah, I'd like to hear the offer. So saying that, let's move on, okay? We already did the baseline reading, okay? We already did the baseline reading. We found out the put options and, oh, no, we didn't. We found out for the baseline reading, we found out what options trading people are using.
Correct.
Okay. Okay. All right. Okay. Now, I've got a different poll up, okay? And today is not going to be all about doing polls, but guys, I want to know you, okay? And gals, I want to know you. I want to know who you are, okay? What's your single biggest objection to using puts to protect your stock? What is your single biggest objection to using merit puts? And it goes like this. First answer, no objection. I've used them before and it saved my bacon. Okay, so you're going to probably help me make my points. Okay. The second answer is no objection. I just don't know enough about it. I just don't know how to do it or how to do it correctly. Okay. Third answer is, no, it costs so much to have a put. I would make more if I didn't have them. Oh, really? Well, I had a lot of folks write me in late 2008 thanking radioactive trading because, I had one fellow write in, he says, you know what, I lost almost 4%, almost 4% when the you-know-what hit the fan. And all my buddies lost over 40% because they had their fund, they had their money in mutual funds. So I said, boy, you must be popular at dinner parties, you know. He said, yeah, I almost lost 4%. Mm-hmm. Wow, okay, dude. All right, so let me go ahead and close this poll. Hey, look at that, multiples of 10. 10% said no objection, I've used them before and saved my bacon. 60% say no objection, I just don't know enough about it. Well, that's what today's lesson's about, so you're in the right place. 30% say, it costs too much. It costs so much to have a put. I would make more without them. Well, I'm going to show where that making more without them doesn't own up. Okay, it doesn't match up. But I will show that it's important to have a put option. I'll bet you everybody that said it costs too much to have a put, I'll bet you every one of those guys and gals that own a car have insurance on the car. I bet you every one of them that own a home have got insurance on their home. Mm-hmm. I bet you every one of them that has a spouse that they love has got insurance on their life. And yet, we don't have insurance on our stock trades, and that's, to me, that's crazy. You know, it's crazy, especially since it's so affordable. Okay, so Mike, we're going to start out with a problem that one of our radioactive training clients had. Her name is Carol. Okay, first names only. And Carol had her stock, and the stock is up from where she bought it. And we're going to also show how to do this starting from scratch, meaning that you don't have a stock that's up from where you buy it. Let's just say you're buying stock today, okay? All right, so we'll show both scenes, all right? I want to make sure everybody understands that, okay? Everybody paying attention? Mike, are you paying attention?
I believe so.
Mike's paying attention, okay. We're going to show two ways. We're going to show if you have stock and it's up from where you bought it, okay? And we're going to also show, well, geez, we're just getting in, just today. Today we're getting in, okay? And show how that works. Okay, so now what? If your stock is up from where you started, it's almost as heart-rending, okay, as having a stock that's down, because you just don't know what to do. You know, there's two different ways to feel like a chump. One way to feel like a chump is that if you sell your stock, right, and it keeps going higher, it's like, well, geez, why did I do that? You know, why did I sell Microsoft in 1984? You know, why didn't I hold on? Mm-hmm. Right? Why did I sell Apple at $200 a share? You know, and when it went to over $6. Why did I sell Google when it was still only $200 a share? You know what I'm saying? Okay, so if I sell my stock and it keeps going higher, I will miss the boat. And by the way, that's a haiku. I couldn't resist. I had to try and be cheeky and clever and so forth. And, well, anyway. Here's the other side. The other side of it is if you've got a winning stock, you've got a stock and it's up, and you hold it, you might get back your profits, right? If the stock goes down, you could actually see a stock that could have made you money if you got out at the right time. You could have made you money, mm-hmm. and yet you sat on your hands, right, and then you end up losing. You end up getting in and getting out a loser, even though your stock had been up. even though you had been right. You're just wrong on the timing. Mike, has that ever happened to you?
Oh, yeah. Dry ships way back a few years ago was one of the most successful trades I ever had over a 3-month period just buying stock, and then it was the biggest loss I've ever had in my portfolio just trading stock.
Oh, boy. Because you, gosh, did you get out and make a profit and then get back in, or did you hold on? Or?
Yeah, would never reach this point, so when I saw that point, I sold to close the stock, and then it kept going up, and I said, wow, this thing isn't going to stop. And so I bought more, and then it proceeded to just crash down.
Yeah, it's heartbreaking. Okay, but the thing is, to solve this problem, and most people have this problem at one point or another in their investing career. And if they don't have this problem, they want to have this problem. You know they want to have a stock that's up from where they started. Okay, but the problem is that they've only looked at two different choices. The two different choices that we've looked at are holding and selling. But that's not the only choices that there are. Okay, there's another, not to be funny, but another option. And the option would be to add the structure of a radioactive profit machine. The radioactive profit machine is my way of putting together a married put play. Now, it's different than a traditional married put. And Mike, we're going to use Carol's example. Okay, she has shares of Visa. The cost basis was $84.60, and back in June, okay, and I made this presentation, this lesson back in June. Okay, so back in June, those shares were trading at 120, so she had a gain to protect. Okay, now again, I'm going to remind everybody. If you don't have a stock that's up, don't check out. Okay, don't say, well, this doesn't apply to me. I'm signing out of the webinar. No. We're going to show also how the same set of steps could be done if you were picking up the stock today. Okay? All right. But anyway, Carol is at a place where her shares were up from where she started, so she's got a $35.40 gain to protect. How's she going to do that? Well, take a look. Here's her cost basis on the Visa shares, and when the stock is up at 120, why then her put options are going to be cheap. And we're looking at a $125 put option. That means it's in the money. In the money means that we're buying a put that's got a higher strike price, a higher face value, right, than the stock is actually trading at today. Okay, it's at 120, and she's buying a $125 put option. Now, why does it cost more than $5?
Well, it's the intrinsic value of the position. We have to pay for both the intrinsic value, sir, and the time value, the time frame that remains on the option itself.
Right. We have to pay a premium for the uncertainty that there is in that stock. That stock might go up to 150. It might also go down to 100 or less. 80. 60. It might go down. And so the uncertainty that's there translates into time value, and time value is what we're going to end up actually paying for. Now, our total invested so far, when we buy the Visa shares, she had the Visa shares already, and when she buys the put, now the total amount that she's put into her trade is $95, okay? But that strike price, okay, of that put option, it's like the face value of a coupon, right? That strike price says that she gets to sell Visa at $125 no matter what. So if the stock goes down to $60 a share, would we use that?
Of course.
Yeah. Yeah. If the stock goes up to $150, would we use this privilege?
No.
No.
Why would we sell it at 125 if we can sell it at the market at 150?
Exactly, okay? It's just an insurance policy, okay? And so, again, we're not trying to talk over the heads of anybody here. If you're brand spanking new to options, you understand this. This is insurance. This is like an extended warranty, All right, so anyway, the amount that's at risk, she's put in 95 and she's guaranteed 125 back. The amount that's at risk is negative $30. Well, how can you have negative risk?
Well, because our cost basis, Kurt, is less than the guaranteed exit from the put option. Our total cost in the position is less than that, so negative maximum risk is equal to a guaranteed profit no matter what happens next, but we still leave the upside open.
Right. Now I'm showing, this is not the graph of Visa, this is the graph of RCI that belonged to a different radioactive trading client, but it's essentially, it would be the same graph, all right? The graph is bulletproof. See, this is a married put play, but there's something missing from this married put position. What's missing?
Well, there's no risk, there's no break even, there's no red line of loss on this position.
Exactly. Okay, there's no way that it's going to lose. And a lot of folks will say, well, Kurt, you know, who says I want to spend that money on the put option? You know, and wait a minute. Well, we already looked at the objections to the put pull. Okay, so let me go ahead and play that. I'm going to just play that here real quick. 10% have no objection. Is it showing? Is it showing?
Yes, Kurt.
Because I can see it, but I wanted to know if users could see it. So you can see it? Folks online, can you see it?
It's there, Kurt.
Oh, okay, very good. Just checking. All right, so 10% say no objection. 60% say, well, no objection, I just don't know enough about it. But 30% say it costs so much to have a put option. Costs so very much. Well, let's handle that objection, okay? Who says I want to spend $10.40? Well, first off, what we're going to do is we're going to learn how to finance the cost of that put option. And there's 11 different ways in the blueprint, you know, my book, and the home study kit, which includes the blueprint, but also some CDs. Okay, there's 11 different ways. We're going to show one or two today. There's 11 different ways. Now, first off, the cost of that put really isn't $10.40 out of pocket. I mean, it's $10.40 out of pocket. But Mike, if I gave you $10.40, okay, and I was guaranteed to get at least $5 back, well, how much more would I be looking for from you?
Well, another $5.40, right?
Right, yeah. If I gave you $10.40 and you gave me a $5 bill now and you said you give the rest to me later, I'd be like, well, okay, Mike, you know, but I'm not looking for $10.40 from you. I'm looking for the $5.40, right? So some of this is guaranteed to come back. Now, here's how this works. The stock was at $120, and it was a $125 put that we're paying for, right? So 5 of that, you know, $10.40 is what's called intrinsic value. It means it's guaranteed back. We're going to get it back no matter what. So it's like it's on deposit. So the difference of $5.40 is really all that we could possibly lose. And if the stock goes down, we'll actually be glad that we made that $5.40 investment. Right? Okay, so that's really all that we're paying. And another thing is we're doing this over a period of, in this case, 3 months. Okay, so really I'm paying $1.80 per month for insurance. So does that sound more reasonable to you, Mike? You know, to just pay $1.80 a share to protect a stock that's up at $120?
You have to lock in that profit, sure.
Yeah, it's like I'm taking the value of the whole shebang and I'm spending 1.5% a month to protect it. Okay? All right. Now, the only thing is I need to come up with that. I need to come up with that $1.80 a month, and there's more than one way to do it. Okay? So, in honor of my good friend, Mr. Monty Python, okay, now for something completely different. We're going to take a look at this critter, and the experienced options players are going to recognize this as what, Mike?
Well, this is a ratio call spread, or a ratio spread, isn't it, Kurt?
And what that means is we're buying 1 call and selling 2 calls. Now, normally that's dangerous. Normally, buying 1 call and selling 2 is dangerous, okay? But before we get into the danger, let me just show the mechanics. This is what we showed Carol back in June. We said, okay, now this is something you could do. We said, look, we're not brokers, all right? And you know, you need to check with your financial professionals and stuff like that. Okay, but let me just make an observation here. This is something you could do. You could sell 2 July $125 calls for every 100 shares that you've protected. You're going to pick up $3 in premium. and you're going to get a total in of $6 per share for doing that. Now, what we're going to do also is we're going to buy one July $120 call for each 100 shares that you have at $5.50. It costs more for the 120 calls than it does for the 125. That's why we're selling twice as many. Okay, we're selling twice as many $125 calls as we're buying 120 calls. Okay, that makes for a net credit of 50 cents, and we've got a 2-for-1 ratio. We've got 2 short calls for every long call. Now, Mike, why would we not want to do that?
Well, it takes on infinite risk, Kurt.
Yeah. We take in 50-cent credit, but it also comes with infinite liability, and the reason for that is this. We've bought one call and we've sold 2, so therefore one of those calls is naked. In other words, if Visa goes up, and it has, hasn't it, Mike? I think Visa's way above 120 now.
Let's take a look. Go ahead, Kurt.
If we are obligated to deliver shares of Visa at $125 a share, okay, we're going to have to come up with those shares no matter what they're trading at. What are they trading at today?
About 157, Kurt.
Oh, good Lord. So we'd have to buy shares of Visa at 157 to make them available to whoever we sold the calls to make them available to them at 125. So that's what, a $32 per share loss. Oh my God! Okay, this is why you don't do naked calls. All right, and it's why you don't do ratio call spreads without knowing what the heck you're doing. Okay, because when you're naked, you're exposed. Okay, that's what the problem is here. So having one long and 2 short calls is normally it's a problem. Okay, but why is it not a problem today? Why is it not a problem to Carol?
Well, because it's done in the context of a greater position. We own the stock, and our shares of stock are protected by a put option. So now, if by entering this spread, if the stock goes against us, we don't have that obligation of the naked option because we own the stock as well. One of our short calls is covered by the long call that we received at a credit, and the other short call is covered by the stock ownership.
Yes, okay. I'm going to repeat what you just said so everybody can hear the same thing in a different voice, okay? When you have the stock on hand to deliver, you don't have to go out on the open market and pick it up at 157, right?
Right.
All right, so this is essentially, there's no risk to your capital for doing the ratio call spread if indeed you've got the stock on hand and you've got it on hand at the right cost basis, okay? And we go over this in the blueprint. This may be a little confusing to some of the folks that are brand spanking new to options. Folks that are spread traders and so forth already that say, wow, I'd like to do a ratio call spread, but it's so risky. But wait a minute, it's not risky if you do it in the correct context. Now, look at this, Mike. Between 120 and 125, this is the net position. This is owning stock, having the stock protected with the put, right, so there's no break-even anymore, and having the ratio call spread in place. This is all 4 legs, okay? Notice what happens between 120 and 125. If the stock closes anywhere in there, and in fact, if it closes anywhere between 120 and 130, there's this peak, this what do you call that?
It's an accelerated sort of peak. We get a tent profit and loss chart, sort of the same thing we may see in a calendar spread or a form of butterfly, for example, where we want the stock to be trading right at a specific strike price to realize the maximum return.
Exactly, okay? And this bump up is something that, we can't get hurt, but we can realize this bump up if the stock behaves a certain way, okay? We get paid when we put this on. We just showed how you get paid 50 cents, pardon me, if indeed you're able to collect $3 per call. What did we do? We sold the 125s for $3 a call, but we sold 2 of them, so that's $6 in. And then we bought one $120 call for more. We paid $5.50 for it. So $6 in, $5.50 out, we get 50 cents in. But guess what? at expiration we get paid again. If the stock's between 120 and 130, if it's between there, we get paid again. Okay.
That's right.
Now, I'm going to have to show how that works. All right. I'm going to have to show how that works. I'm going to show one of 5 ways that you might realize that second payment. Okay. So we talked about how doing this ratio call spread has no upside risk to it. All right. All this upside risk, as the stock goes up, and then we have all this risk from being naked. Well, that goes away because we do this in the context of the stock.
Mm-hmm.
We do this in the context of we own a married put play that's keeping us out of trouble. But how is it that we can get paid twice for this play here that I called the money net, or it's income method number 5 out of the 11 methods in the blueprint? Well, let me go ahead and explain. If the stock closes below 120, right? This is 120. The stock closes below it, we just keep the 50 cents, and we could do it again. Okay? Because remember, our put option has got us protected out to September, and we're doing this in July. All right? So July expiration comes. If the stock is below 120, we keep our 50 cents, and we could do it again. Okay? But if the stock ends up somewhere in between 120 and 130, we're going to get paid a second time.
That's right.
Here's the deal. If the stock finishes at $125 a share, Mike, what happens to the $125 calls?
Well, if they're at 125 exactly, they're going to expire worthless, aren't they, Kurt?
Mm-hmm.
So we don't
expire worthless. Uh-huh.
We don't have any obligations to fulfill on our stock or on our short call obligation.
But then what about these $120 calls? A call option gives me the right, not the obligation, but the right to buy that stock at 120.
Mm-hmm.
Okay? And I could either exercise that right or I could sell it to someone else. What is the price of this $120 call going to be when the stock's trading at 125?
Well, it's going to be $5 minimum, depending if you have time.
Right. Okay, and let me point something out. We've been paid to own it. We've been paid to own it. By doing the ratio call spread, we took in 50-cent credit, right?
That's right. Mm-hmm.
And now here at expiration, if the stock is at 125, right, the 125s go to nothing because, nobody's going to exercise their $125 call option if it's right at 125. But the stock is, the $120 call is worth $5, and we get to cash it in. Okay, now that's one of the ways. But I'm going to go ahead and show another of the ways to take your second credit. And this is what really happened. We performed this presentation, this lesson, in June 2012, where we just showed her, hey, look, this is what's possible to you. And then we went on to some other things, okay? But Visa closed at July expiration. It closed at $125.75.
Mm-hmm.
Now we're going to see one of the 5 ways to manage the income method that's known as the money net, okay? I'm going to show the money net. We buy to close one of the $125 calls near the close of business. Now, Mike, the stock was $125.75. It's a $125 call. Why isn't it 75 cents to close my call option?
Well, the market maker is going to have some difference there, Kurt. You're not going to be able to close it at intrinsic value just an hour before or 2 hours before expiration unless it's, 50 to 60% in the money, for example.
Greedy bastard. But yeah, that's true. I'm going to have to pay a little premium. Okay, so near the close of business, we're able to close out of the one of the $125 calls by paying 90 cents.
Mm-hmm.
So we're paying 90 cents. Now, I want to point something out to the covered call players. You see the value of this. If the stock has gone from 120, which is where it was when we first did the ratio call spread play, if it's gone to over $125, for me to spend 90 cents to hold on to it, that's a good investment, right?
I think so.
Yeah. Yeah, for me to spend 90 cents to hold on to the stock, it's a good investment, okay? And so we're closing the short calls that are obligating me to deliver the stock. Now, have we missed anything? Have we missed anything? You know, the money net is composed of one long $120 call and two short 125s. I've just closed one of the short 125s. So what is left?
No, we still have the long 120 call and the short 125. And as ADP just pointed out, one of our attendees just pointed out to us, is that, well, what this is sort of a covered call or a collar combined with a bull call spread. And that's right. Once we close that short call, that's what we have left, a bull call spread, a bull call debit spread that was received at a credit.
Yeah. Yeah, that's what's left is a bull call spread. But remember, we got paid on the front end. We got paid 50 cents on the front end to put this together, and now we're paying 90 cents to keep our stock. Okay. All right. So that what happens in the middle of the night here, Mike, is that my broker's Options Express. Okay. Now I'm not saying that to endorse them. I don't get anything for saying that. It's just who I use. You might check with your broker, and you also might check with the country that you live in, okay, what the rules are and the laws and so forth, and whatever exchanges that you trade. But the way that my broker treats this is in the middle of the night, they look and they say, oh, look, Kurt has got a long $120 call option. So since the stock is above $125, above $120, we're going to buy that for him. We're going to exercise. It's called automatic exercise. And then the broker also looks and says, hey, wait a minute, you know, Frankenberg's also got an obligation to deliver 100 shares at $125. And so they do that, and that's called automatic assignment. Okay? And so with the stock closing at 125.75, and I've got this bull call spread in place, I don't have to do anything. In the middle of the night, my broker buys 100 shares at 120 and sells 100 shares at 125, and I pocket the difference. I get a $5 bill for every share of stock that I own. If we're doing this with 100 shares, which is what we're doing with each of these contracts, that's $500. So did you get that? We took in 50 cents at the start to do the money net play, right? Number 5. Took in 50 cents at the start, and then we spent 90 cents to keep a stock that's traveled up by $5. So, Mike, is it okay for me to spend 90 cents to keep a stock that's gone up by $5?
I think so, don't you, Kurt?
Yeah. All right. So essentially, so far, it's like I've spent 40 cents. But then I get paid $5 for the bull call spread that we got paid to own, right? And so that's $5.50 out, and then management costs of, $5.50 in, and the management costs of 90 cents out equals $4.60 of income, and we've got a stock that's up by $5.
Right.
Up by $5 from where we started. So are we, number one, are we glad that we held on to the stock? Is Carol glad that she hung on to the stock?
Exactly.
Yeah, especially today, now that Visa's at 157. Okay. What about, are we glad that we did the income method number 5 play?
Well, we generated a little bit extra premium up front, but then we got paid twice at the end to own it, didn't we, Kurt?
Right. Yeah, we got paid 50 cents at the beginning, and then we got paid again when we closed it. Okay, so the way I read this is we've brought in $4.60, and our stock went up by $5. So was it good to make that investment on the put option? I think so. Okay. Now, if you didn't understand this the first time, don't despair. All right, we've got some products that will help you. It's painstaking detail in the blueprint and the home study kit. All right, but all I want you to take from this is, number one, limiting your downside risk by using the put option. Number 2, using one or more income method to pay for the put. And then number 3, you become bulletproof. Okay, so that's the steps here of the process. Now, can every trade become bulletproof? No. You know, when you start from scratch, you might, you know, if you buy your stock at today's price, okay, you might not ever get to bulletproof. But if you don't ever get to bulletproof, at the very least, you can't get hurt. You can't get hurt by losing too much. Okay? Let me explain that. What had been the problem? Well, with Carol, she had her shares of Visa at 84.60, and she wanted to protect the gain that she had had. She had no guarantees, all right, and what we did was we taught her to build a fence around her stock with options. First, we introduced the put option. Then, to pay for the put option, we did one of 11 income methods. Here's the deal. We grabbed 50 cents on the money net, and then we got paid more later. In the case of Visa, it was $460 total that was captured in the money net in the July play, and there's still August and September left, right?
Mm-hmm.
Okay. So before, the stock was unprotected, and now the stock has a nice warm overcoat and an intriguing possibility. We may capture more than we spent to protect it. So if the stock goes down, we don't get hurt. And if the stock goes up, well, we just may be making more than we spent on the put option. Okay? Carol had been in this place with a 35.40 gain to protect, and now she's got 460 in hand without selling the stock. Did she have to sell the stock?
No.
No. Okay? And she still has that put option. That put option has a longer duration than the money net play. So she still has a $30 locked-in gain, 460 in hand, and unlimited upside. You see, after expiration, she doesn't have any obligations at all. She could do income method number 5 again if she wants, or she doesn't have to. What she does have is unlimited upside at this point, and 11 different income methods to play with. Now, Carol may cash in the stock at 125 no matter what happens to the downside. If the stock goes down, that's marvelous. She gets to cash out near the top, right?
Mm-hmm.
On the other hand, out of the 540 for the insurance policy, okay, remember it's like 180 per month, okay, 460 of it's already paid for. She's bulletproof because she could also use a different income method right then. Okay, and so far we've only played the money net in July. We've got August and we've got September still yet to go, and 10 other income methods to use. And in Carol's place, I don't know if I'd use income method number 5. I think I might use one of the others at that point.
Mm-hmm.
Okay, so what should you do now? Well, not everyone's going to have the same situation as Carol. That's why you need all 11 income methods, okay? But we're sold on using the radioactive profit machine, right? Do we like the idea of being bulletproof? Let me ask something. Let me see if I've got, First, do you have a stock that's up? This is for everybody that's on the line. Do you have a stock that's up? And if you do, please send us the symbol and your cost basis. Send us the symbol and the cost basis if you'd like for us to. And there's no obligation, and we're not charging for this, and we're also giving no guarantees. Okay, we just want to analyze the position for you and say, hey, have you thought of this? Because I did this for one fellow that owned McDonald's shares. Mike, I was able to show him how to get paid to bulletproof his stock. That was crazy. He got paid to bulletproof his stock. He was very happy with me. So this is a question for attendees. Okay, here's another question that you might be asking me. That's great, Kurt, but what if I don't have a stock that's up from where I bought it? Well, okay, that's fine. Let's use the same example. Remember, there's 3 steps to bulletproofing. Number 1, you begin with single-digit risk or less. Number 2, you use the income methods to cancel even that risk. And then once you have done that, once you've collected more than what's at risk, then you are bulletproof. Okay? What if we had gotten in without Carol's cost basis? What if we got in on that same date in June when the stock was at 120 and that $125 put option was 1040? Well, our cost basis wouldn't be 95, would it, Mike?
That's right.
Our cost basis would be 130.40. We'd have a higher cost basis. Okay, and because we have a higher cost basis, we've got some risk. Our guaranteed exit is still 125. So the difference between what we've invested at 130.40, okay, and the amount that we're guaranteed to get, even if Visa has a gap down overnight, even if overnight the value of the shares are cut in half, like what happened to me, okay, way back more than 10 years ago. If the stock went down real hard, the most that we could possibly lose is the difference here, the $5.40, and that's 4.14%. So I'm just going to ask a question of our audience, okay? If you used puts last year and kept your plays, all of your bullish plays down to, say, 5-6% max, okay, and you had 11 different ways to pay for those puts, would that make a change for the better in your account? Okay? Would it make a change for the better? Okay? Now, let's be honest. If you think it's no change or you might have done worse, go ahead and say so. Look back over your last year. If you had any losses that were greater than 6%, think about it. Okay? If you could take whatever that loss was and make it less than 6%, would that be a good thing? So another one is I might still have lost, but I would have lost $1,000 or more less. I would have lost $1,000 less, or I would have lost, $10,000 less. I would have lost $1,000 or more less than what I did lose.
Mm-hmm.
Okay? Or I lost overall last year, but I would have won if I'd have done that. Or, you know what? I won last year, but it would have been even bigger wins. Or I would have been one of those few that said, I'm very happy with my trading. Who said they're very happy with their trading? Was it like 8% or something ridiculous?
That's right, Kurt.
Yeah, 8% today. Okay, so far I've actually only got answers in 2 categories. This is interesting. Okay, so one more time, I'll give it to you. No change, or I think I would have done worse. I might have lost, but it would have been less than what I did lose, right? I lost overall last year, but I would have won if I had done that. I won last year, but I would have had bigger wins. Or finally, I would have been one that said, I'm very happy with my trading. Let me go ahead and close this poll. I think we got everybody in there that's gonna have the opportunity to vote. And wow, we got 11% saying, I might still have lost, but I would have lost a lot less. They'd be at least $1,000 to the better, right?
Mm-hmm.
Okay. And then the remainder said, I won last year, but it would have been bigger wins. It would have been bigger wins. So that's pretty cool. I think there's an 11% missing here. I'm looking at the lines here, and it doesn't all add up to 100%. I wonder why that is. Do you think one of these poll answers just blew out?
I don't know. I can look into it later, Kurt. I have no idea, and I won't be able to check it now online, so we'll have to look into that later.
Okay. Well, at least, nearly 8 out of 10 are saying I would have had bigger wins, okay? And the folks that did lose last year and think they might still have lost are saying, well, it would have still been, this information would have still been worth $1,000 to me. Okay. Mike, are we back on the screen? Are we seeing income methods reduce the break-even?
That's right, Kurt.
Okay, so when you buy a married put, this dotted line here represents what you paid for your stock and your put option, okay? And usually your bottom floor here, okay, is lower. But by using the income methods, you reduce that gap, okay? And then by using that repetitively, like for example, if we got into Visa in June at the exact price, instead of trying to protect it, if we got in at that price, well, the at-risk amount gets offset by the income, right? And if you do that enough times, you become bulletproof.
Mm-hmm.
And the Visa example that we showed, even if you weren't Carol, if you got in at the same time that we were showing Carol how to bulletproof her stock, you could also have bulletproofed yours. Okay, kind of cool. Okay, so here's the question: did you get what you came for? I want to know if this lesson was helpful to everybody, and I'd like to see if you could see yourself using these techniques. Okay, do you see yourself using what we gave away for free today? And this will be our second to last poll, guys, and I appreciate you being so patient and doing these polls with me. But did you get what you came for? Could you see yourself using what we gave away for free? Can you see how using a put could keep you out of trouble, or can you see how leaving your upside open can increase your returns? Do you think you just want to know more about these income methods before trying? Or do you have a success story that you'd like to share? If we've probably only got newbies here, Mike. I don't know that we've got a lot of folks that already have the blueprint and so forth, but if there is someone
well, we have
out
many
there,
who have ordered the blueprint, Kurt, that are online that are waiting for it to be delivered.
they've
They got it
ordered.
at the end. Yeah, they got it at
I
the end of the
see.
special offer. Mm-hmm.
Right. Okay. Now this is going to add up to more than 100% because guess what? You can actually select more than one of these. Okay. Okay. Cool. Let me go ahead and close this poll here, and I'm going to share the results. Like I said, that was the second to the last. Okay. 18% have come to a number of radioactive training events and it's helped already. 27% say I see how using a put can keep you out of trouble. 45% say I see how leaving upside open can increase your returns. Absolutely. And the lion's share, 55%, say I need to know more about these income methods before trying them. Yes, I agree. You see, I don't expect that out of the one free webinar you're going to get over a decade of experience that has gone into the blueprint. Okay, I just don't see that. I started writing about married puts back in 2002, and folks were looking over my shoulder. While I was trading, I posted every trade back in 2002, and I was picking up Amazon and eBay and Yahoo with very, very low risk. And some of the viewers were saying, well, geez, have you written a book? And so I ended up doing that. And after writing a book, we established a bit of a community, and then we had a lot of folks writing in with their success stories. And some of the income methods have come out of those conversations that I've had with people that are winning with this strategy. And also people that were having challenges and saying, hey, this is a challenge for me. I'm not getting the results I want because of, X or Y or Z. And then we put it to the community, and more folks are coming forward. Guys, you know what? If you want to have all that information distilled in one place, the way to do it is to get the blueprint. Okay, so now what? Well, it's time to consider picking up the blueprint or the home study kit. Now, this is the part where I told you early on, we said, hey, at the end, I'm going to give you a 5-minute commercial. Here it is, okay? What's the biggest thing in the way? This is my last poll question. What's the biggest thing in the way? Biggest thing in the way. Now, go ahead and think about that. And while you're thinking about that, I'm going to tell you how much it is for the home study kit. The home study kit is the most expensive product that we offer. It's the blueprint, and it's also, along the way, Mike and I have made 6 CD teachings. They're recorded teachings like this that are recorded, and there's 6 of them, and they're not like 6, 20-minute deals, all right, to where it looks like, hey, this is a whole lot, but it's really just 2 hours. No, there's, oh God, there's at least 20 hours of instruction on CD. Okay. Well, maybe that's an exaggeration. There's at least 15 hours. There's at least 15 hours of instruction on CD that we've got here, and it's $5.99. Now, what if that investment were a married put? The most that you could lose would be $5.99, right? Mm-hmm. Mike, if you were playing $10,000 and you got into a married put position that risked 6%, the most you could lose is the 6% or $600, right?
Right.
But your upside would be unlimited. Now, once you used an income method that cleared up all that risk, then you'd be bulletproof, right? You're
That's
bulletproof
correct.
in a few positions. Yeah, you're bulletproof in a few positions right now, and you've been bulletproof in others. In fact, that one that you ended up pulling 59.8% out of SLW. Mm-hmm. You were in that trade for like 5 months, I think it was.
5.5 months, Kurt.
5.5 months, but 4.5 of those 5.5 months, you were bulletproof, right?
Right.
What a cool place to be, okay? So bulletproof just means that, okay, you've removed all risk by using the income methods. Well, we're going to remove all risk to owning the home study kit by giving you 100% money-back guarantee. So we still have the unlimited upside, but we have 0 at risk, okay? So I'm going to recommend that you pick up the home study kit. And now I'm going to go ahead and ask, what is the biggest thing in the way? What is the biggest thing in the way? Boom, there we go. And we've got 5 different answers. Number one, no objection. I'm seriously thinking. Let's hear the offer. Okay. Second one is, hey, I've gotten excited before, but then the claims fell through. Hey, you and me both, buddy. I I did this weekend seminar. You know how much they cost to attend? It was $3,000. And then also I got it into the trading software that they were saying, and it was $3,500 for the software, and it was $99 a month for the data feed. I got into all that. Then I ended up going broke. So that was kind of no fun. Nobody gave me 100% money-back guarantee. That would be nice. Okay, $600 is a lot of money. I don't know if I believe your guarantee or you give so much away free, I'll just keep coming to the webinars. Mike, do you remember that one fellow out in, was it New Jersey, the doctor?
Yeah, I think it was up there in New Jersey, northern New Jersey.
We had a fellow that wrote us in, and we looked at his record. He had come to 127 webinars. We do webinars twice a week, and he had come to 127 webinars. He says, hey, guys, I've learned income method number 1. I kind of figured out for myself what income method 2 was. You did a couple of webinars on 3, 4, 5, and 6. And when are you going to do one on 7 and 8? Yeah, I made $900 on the last play. I said, you're kidding, right? You made more money than the blueprint costs, and you want to prompt us to go ahead and give away another couple of free income methods. Oh my God! I wonder how many how many investments he passed up that he could have done well on on the way. Okay, Mike, I've had that pull out there for a while. Okay. So 25%, no objection, marvelous. 25%, I've gotten excited before, but then the claims fell through. Well, listen, gosh, I'm on my second marriage. I got excited before, and then the claims fell through. But they say that marrying again is the triumph of hope over experience. And the fact is, you know what? I am glad that I took that plunge. I've been happily married now, 4 years to my bride, and she's just marvelous. And Mike, you've met her, and the point is sometimes you have to experience something bad before you can experience something good. And I'm sorry if that happened to you. Okay, you got excited before, but the claims fell through. Listen, I don't know if they offered you a money-back guarantee, but we do. 38% say $600 is a lot of money. Okay, yeah, so is $1,000. And the folks that didn't say that they would have done better said that. The folks that didn't say, wow, I would have made more money last year, did say that they would have lost less. They would have lost $1,000 or more less than what they did lose if they had simply followed the purchase of the put the way that I showed. So, okay, if $600 is a lot of money, then what about $1,000? What about what we showed you already that you just told me you would have done better by?
Okay, yeah, and I got to pause for a minute here, Kurt. We're just going to take one question because we're at 1:15. We do have to wrap up here real quick. We had a couple
time already. Okay, good.
We had a couple of people send in some of their cost basis. I'll send that to Kurt, and Kurt might get back to you. But David, I have to address this because David, this goes back to what you were talking about a few minutes ago about attending the webinars and just watching it and continuing. Well, David asks, okay, well, won't I have to pay triple the commissions if I have to enter in the spread trade, then buy to close the call, then close the spread? I've been doing this for 4.5 years. So I've been trading the radioactive trading techniques for the past 4.5 years. I've been trading options for 10 years. Started out with covered calls, moved into collar spreads, and moved into diagonal spreads and horizontals. And despite the fact of how you look at it, when you look at everything over a 12-month trading period, whether you're doing covered calls, whether you're doing naked puts, whether you're doing the married put techniques with the different income methods, you can't have this shallow view of what happened in the past 30 days. I have to pay twice as much commissions to roll this income method number 5 or do this adjustment. Because over the course of the year, your commissions for doing covered calls, doing naked puts, doing spread trades, buying long calls and closing long calls, for example, are all going to come out to be the same. It's the price of doing business. And if you're really concerned, I've heard Ernie say this time and time again to investors the past 10 years I've been with power options. If you're really concerned with adding an extra commission to buy to close a call and roll it, or if you're looking at a spread instead of just selling a call and you think that's an extra commission, you might want to reevaluate why you're trading options. If you're concerned about that extra $5 or $6 for one more commission, you might want to ask if options trading is right for you, because that's the price of doing business. You are going to have to roll positions. You are going to you find yourself in a position where you need to roll either down or up, whether you're just buying a call or you're just buying a put, just speculating on the market movement. The commissions are an essential part of this, and that's going to be the trigger. Now, Kurt, we did a trades a few years ago. I'm sorry, last year. We showed an example of your Altera trade, and in one of those Altera trades, you traded it twice. The first time you made about 12%, and the second time you lost about 5.6%. And the trick is that you were doing that with 500 shares and 5 puts, and then you did some income methods, and I'm sorry, you did.
Let me describe that to you. I'll give you the very fast 30-second summary. I bought 500 shares, and I also bought 5 puts. I did the ratio call spread play that I just showed by selling 10 calls and buying 5 calls. I bought to close and captured income, and then I moved the put option. Okay, I sold one put option and bought a different put option. I did all those transactions. Then I sold the stock, and then I sold the put separately. Okay, so I did all those transactions. It made my 12% return on 500 shares of stock into an 11.9% return. Whoop-de-freaking-do. The cost of all those commissions, that was a very heavily managed position. But the cost of all those adjustments and so forth still ended up taking away 1/10 of 1%. So...
And I have a smaller account than Kurt, and I trade usually only maybe 200 shares or 300 shares in my Mary puts instead of 500 shares. And I noticed the commissions as well, to the tune of maybe 0.3% or 0.4% of the profits that I make, or only adding to maybe 0.2 or 0.3% of a small loss I might take as well. We talked about TLM, Kurt, that dropped 50% from when I opened it, and I only took a loss of 4.5%. That was with commissions included. If I didn't include commissions, it would have been a 4.2% loss, yeah.
Now, another thing to think about is, Mike, that same year that you took a 4.5% loss, you also took a 59.8% gain.
And that was including commissions, yeah.
Including commissions. And also the 59.8 is considering not just your investment in the stock, but also your investment in the put as well. Your stock plus your put. And if you had been trading calls, you would have made a profit too, but it would have been single-digit percent.
And I would have lost closer to 44-45% on the other stock.
Yeah, on Talisman Energy, you would have lost 45%. So it's kind of cool that you're able, with the Mary Put play, to cut your losers short and leave the upside open on your winners. That's right. That's the way to do it. Mike, I've been flashing up just random testimonials that we've taken over the last 5-6 years. I only started writing them down in I don't know, I guess here's February 2008. That's about the time I guess I started saving them. Yeah, I've just been flashing up some of these guys, and thought I would allow folks to take a look at that. Gosh, did we show how to get the blueprint?
I don't think you did, Kurt.
Okay, let me break out of here and get over into radioactive trading. And folks, here's what to do right now. If you want to pick up the blueprints, we've got some wonderful offers going on right now, along with the blueprint. We're the Home Study Kit. Home Study Kit, again, is the most expensive deal here. If you find that you learn well and you retain information well and you get it with just examples that are in the book, the blueprint's your best value. That's $339. If you think you'd like to have multimedia instruction, kind of like what we're doing now, then the Home Study Kit is your best way to go. But along with these, we've got some special offers for folks that are on the line, and it's going to include a consultation with Mike on setting up power options. It's going to include a month of power options, 1 month of power options, and a coupon if you want to try out Fusion. Fusion's a subscription where you get to look over Mike's shoulder and Ernie's shoulder, other traders that are using the radioactive trade strategy. you can get your first month for only $10 instead of $69, and so that's another incentive. But there's a lot of free stuff that we're giving away along with the blueprints if you pick it up today, or the home study kit. So here's where to go. It's radioactivetrading.com, and hit the products tab here. Now, if you'd like a few recorded teachings, like the teaching that's today, the stuff that we give away free, it's of less value because we don't give all the parameters. We don't, we can't do it. I mean, there's not enough time. But if you want to see some other examples than the ones we just did, you could just pick up this here, the 4 Insiders Secrets of Trading. And it's only $29, but when you pick that up, that $29, we give you a $29 coupon to apply towards the purchase of the blueprint or the home study kit, okay? So I don't know if those bonuses will still be around when you get there, but certainly the home study kit is worth its weight in gold, and we guarantee it. We have a money-back guarantee on everything that we do here. Okay, home study kit, blueprints, and if you pick this bugger up, you'll also get a $29 coupon that will be applied towards the purchase of the blueprint or the home study kit. Okay, Mike, I think that's all I've got to say about that.
Okay.
Did anything come in that any questions that we should settle?
No, I think we're good, Kurt. We want to wrap up, and you can join us all Tuesday afternoon at 12 noon. We'll be doing more of a basic presentation and introduction to the radioactive trading techniques, of course. And we did have some customers send in their values for their stocks that are up in price, and I'll send those to you, Kurt, as well. Looks like Morris went into TXN, which is one of the ones that I was actually considering as a married put a couple months ago. Actually, yeah, probably mid-November, and I didn't get into it, but he's doing well on that. Yeah, so I'll send you those numbers. And, of course, if anyone thinks of any questions later on, you can just go ahead and send us an email to support@radioactivetrading.com. And, of course, there's contact links at the bottom of every radioactivetrading.com page.
Very cool. All right. Yeah, Mike, I'm going to probably, folks, if you're sending your stuff in, I want you to understand you're giving me permission to use it as an example. I'll only use your first name, okay, and we don't have to get into any details or expose anything to the IRS or any of that stuff, but if you'll just give me your stock symbol and the price that you got in at, I'm going to make it maybe into a blog post or a webinar or something like that, and I'll also give you some ideas free of charge. So, very good. Okay, Mike, you're the best. I'll see you on Tuesday.
Sounds good, Kurt.
All right, folks that stuck around, man, there's a whole lot of you. Thanks for coming, and we'll see you out there. Happy trading. Bye for now.